Cool. All right, Sean. Ladies and gentlemen, it's a great pleasure doing a conversation now with my dear friend Sean Fieler. Well, I'm pretty sure you all know about Sean's work and about his company. And what we said prior to this conversation, we said we would like to briefly talk about macro markets, then discuss valuations in markets, trends, and then also briefly talk about some good stock ideas and conviction investments that Sean has. So normally I am presenting my case for gold here, but now I'm in a different role, but I truly look forward to this conversation with you, Sean. Sean, thanks for taking the time.
Ronnie, I really appreciate you being willing to do this, and I look forward to the conversation.
Excellent. Well, obviously you're sitting in the office. I'm here already at home. I hope the kids won't interrupt me, but we are all getting used to working from home nowadays. Sean, I would like to briefly introduce you for our viewers. Sean graduated from Williams College in 1995 and thereafter joined Equinox Partners. He's the firm's owner and CIO. He spent the entirety of his career traveling the globe, analyzing stocks and focusing on companies in emerging markets and the resource sector. Well, that sounds very familiar. It sounds very much like my bio, actually. With 26-year track record and 700 million assets under management, Equinox Partners seek to be a high conviction, low turnover investor in public companies that they believe combine value and quality. As contrarians, they primarily invest in precious metals miners, emerging markets, operating companies, and E&P companies. I think there's many similarities, but also differences between our investment styles. Now, Sean, I think the main difference that I see in terms of the investment style is that we are very much top down. So we basically allocate capital in our funds, especially in our inflation fund, based on our inflation model that basically tells us when to play offense and when to play defense, while you're definitely a bottom-up investor. And I know from our conversation before that you really crunch the numbers, that you really check and double check those companies at length, that you focus very much on governance issues, for example, that you try to be I would say a very long-term and very loyal investor. And I already saw in the preparation for this call that your portfolio is very much concentrated. So does that sum up your style already, or what did I miss, Sean?
No, I think that's accurate. I think the kind of the defining features of what we do are we're better business quality investors. We're looking usually for that value and combination of value and quality in spaces where other investors aren't. And we try for, a 10-year holding period. We really see it as a long-term partnership with the insiders, with the board and the C-suite of the companies in which we're invested in. And, we've been doing the same thing for 26 years. I think you captured it pretty well.
All right, perfect. Well, I would say let's start with a little bit of macro perhaps, and let's talk a bit about gold a bit. I think we both attended the Precious Metal Summit in Beaver Creek, a fantastic conference, but also Denver Gold in Colorado Springs. For me, it was obviously a bit harder to travel to the US. I had to get a national interest exemption, and I had basically to testify why it is in the national interest of the United States that Ronnie is coming to the US, and I had to show why it will stimulate US GDP growth for me traveling to the US. So at the end, it worked well. It was extremely nice and insightful. First of all, to meet so many long-term friends, colleagues that I haven't seen in person for a while, but also those company meetings were truly spectacular, and I was overwhelmed with, I would say not all, but the majority of all, I think 80 meetings that I had all together. Sean, what was your impression attending those conferences?
Well, it was great to get out and actually, meet people in person again for the first time in a long time. Certainly the case for us, as it was, I think, for many of the attendees. But I think as great as that was, the overall tenor of the conferences, both of the two, was, I think, one of real pessimism that gold stocks were down as much as they were year to date. That gold's performed so poorly as other commodities have done so well. And so, somewhere between, subdued and despair, something in that range was kind of how I'd capture both of those two conferences.
Yeah, I mean, for me, sometimes I felt like attending a value conference, because, companies were talking about, raising dividends and paying off their debt, and margins that we usually see, not in the gold sector, but in other sectors. But I would say one topic that is definitely a concern for many investors, but also for many companies, is the topic of inflation. And my keynote at the Precious Metal Summit in Beaver Creek was titled "The Monetary Tipping Point," where I basically made the case that inflation is not transitory, and that that basically the COVID crisis was the tipping point for inflation, when this whole inflation pendulum is now swinging from basically the great moderation, where deflationary forces were stronger than inflationary forces, now to an environment where I think inflation rates will settle at higher levels than previously. And you can see on this chart, for example, which shows obviously the 1960s and then the highly inflationary or stagflationary 1970s, where inflation rates reached up to 15%. And then, of course, Paul Volcker came in with the job to kill inflation. And yeah, he introduced very aggressive monetary policy. He was probably the most hated man in the US. He caused a recession, but he also did his job because he killed inflation. And then the great moderation basically did set in. And from my point of view, I think that we are now we have now seen this tipping point where really those inflationary forces are becoming stronger and stronger, while the majority of central bankers, politicians, economists, and also investors still believe that we are in some sort of a great moderation environment, because they got so used to low inflation rates. So, Sean, what do you see as a US investor, but also just experiencing from daily life in the United States, but also talking to mining companies when it comes to the topic of inflation? Is it a topic in the US again? Do you see it affecting the mining companies already? If then, on what side of their businesses? What's your take on this topic?
Yeah, so let me give you, before I get into specifics about what I see in terms of cost inflation and capital inflation, I agree with your kind of overarching framework as it applies to capital markets in the last 40, 50 years of history, really the post-World War II period. I think one of the things that's missed in this kind of economic analysis is the geopolitical overlay, right? So Bretton Woods was very much a result of America's success winning the Second World War. And then our salvaging the dollar kind of as a center point of the world's financial system, the world's reserve currency, has to do with Volcker and perpetuating a lot of that centrality the dollar had de jure under Bretton Woods. We won the Cold War, and so you had then a reason why the dollar would be just central to the world's monetary system. Going into this century, a lot of those factors are kind of less true, less persistent, and I feel like in 2013, when we couldn't get Republicans to push back on the confirmation of Janet Yellen, where this was an easy money Fed candidate really after the immediate crisis of the 2008, the global financial crisis had been addressed with extraordinarily easy monetary policy and quantitative easing, but we decided to perpetuate that. That's where really I think we went kind of all the way off the rails. And we worked with the Republicans in 13 to try to get pushback on Yellen's confirmation. We got 26 Republicans to vote against her confirmation, but really we couldn't get the overwhelming majority of Republicans to oppose easy money. We saw that again with the Shelton confirmation hearings. Is the Republicans just as a party weren't really willing and still haven't really been willing to go there. And so what's happened politically in the United States is as the underlying facts and the geopolitics supporting the dollar's reserve currency status have changed, what should be the party of sound money hasn't really adjusted. And I think that's an adjustment that we still haven't really gotten to in 2021. And so I see that as kind of the underpinning for what we are in now, which I agree with you is very much a higher inflationary environment with a Fed that is, I think, pretty impotent in terms of the mining space. We're going to see already in consumables mid to high single-digit rates of inflation. We haven't really seen the mining companies move their capital budgets. I think that's the next shoe to drop, so to speak. And the cost increases there, I think, are going to be much higher than what we're seeing in the consumables.
Very interesting. Now, I think when we talk about the price of gold itself and the topic of inflation, many people are, I would say, a little bit disappointed when it comes to performance of gold now in an environment where everybody's basically talking about inflation. Now, the big question that many people probably ask you, but also ask me and my colleagues is, why? What happened to gold? Why isn't gold this a good inflation hedge anymore? So I just before did a big webinar with a couple of hundred participants, and many questions were about the topic of gold and why it's so disappointing. And I said basically there's a couple of things that we should stress. First of all, gold was up 25% in dollar terms last year. And in 2019, it was up 19%. So the performance was spectacular in 2019 and 2020. This year to date, it's down, I think, 5% in dollar terms, while, for example, on a euro basis, it's already up 2% since the beginning of the year. So it's actually not that bad, and we shouldn't expect Bitcoin-like performances from gold, but of course the volatility is also different compared to Bitcoin. Then I think talking about Bitcoin, I think that Bitcoin means opportunity costs nowadays. I really see that when I talk to journalists, for example, they don't want to talk and to write about this boring gold. They are much more interested into Bitcoin and the crypto space. So I think it has definitely stolen some media attention from gold. And I think that the third thing, which is from my point of view most interesting at the moment, is that it was a bit like sell the rumor, buy the fact. So I think gold really hated this whole tapering discussion. Now that we know tapering is starting by November, there will be an end, I think, in July 2022, and then we should see at some point, I kind of doubt it, rate hikes. I think now that this uncertainty is out of the market, I expect gold to profit from that, and we saw that exactly on the day after the tapering announcement, that gold made a pretty big move. So what would your reply be to the question, what's up with gold?
Yeah, I think you got the principal problem. I'd say, yeah, Bitcoin has taken a lot of kind of oxygen out of the room. I think the principal difference with, say, the 1970s and its inflationary period where gold did very well is that financial assets are doing very well right now. So if you can own your favorite compilation of S&P stocks and make 20% a year, why are you going to
Yeah.
go invest in this niche market that most journalists are no longer that familiar with? So I think that's been the number one problem. In terms of the reaction to the taper and monetary policy, I think there's just a lot of inertia in the market.
Mm.
And I don't think maybe most financial market participants really appreciate what can happen when the central bank really does lose credibility. And the idea right now that we have a Fed trying to taper at the same time that the Biden administration is going to go and interview Lael Brainerd for that chairmanship job. Just the idea that they would be applying that kind of political pressure to a Fed chair who's trying to taper, I just think speaks volumes to how politicized monetary policy has become and how incompatible that's going to be with kind of the low rates of inflation that we've experienced historically in the United States.
I agree. Although I have to say, on a relative basis, the Federal Reserve is doing a much better job than the ECB, because the ECB doesn't even think about tapering yet. And I think as soon as they start thinking about raising rates, we'll also already be in the next recession. But yeah, I agree. I think that Lael Brainerd will be nominated. Actually, I think.
Really?
Yeah, I think so. Yeah.
Well,
But we'll see.
that would remove any ambiguity because Powell started off as at least wanting to try to normalize and failed and hasn't tried since, at least with any vigor. Lael Brainerd, I think, really represents an explicit effort to politicize monetary policy in a way that I think is really, even on the surface of it, hard to defend. And I think we've already accepted quite a bit of financial repression in the United States in combination with easy money. I think if that's the way this administration is going to go with respect to the Fed, we're going to see just a lot more financial repression. And all of it should be good for gold. At the end of the day, I think that's going to be an asset that's going to be a real beneficiary, both from easy money and from institutional problems at the Fed and from financial repression.
Yeah, agree. Absolutely. Now, let's talk about the mining space. I just found this great table by Trey Rake, which basically shows that um, uh, S&P valuation versus the GDM index, and it's a fantastic overview about. Unfortunately, this joke doesn't work in English, but in German we say spottbillig, and I say they're sprottbillig, because Eric Sprott, it seems, has now a stake in basically every mining company because he says he sees lots of value in this space. But spottbillig means very, very inexpensive, and not only on a relative basis, relative to the own history of the mining space, but also relative to the S&P, for example. And what you can see on this chart is some valuation multiples, price earnings, price cash flow, price EBITDA, but also the margins really look healthy. Dividend yields 2.3%. Debt ratio came down significantly, and this leads me to a question, because I read your last Q3 letter that I truly enjoyed reading, and you wrote that the first time Equinox Partners Precious Metal Fund owns 4 million plus ounce gold miners, which is roughly 24% of the portfolio. And the reason is basically because the four companies owned by the fund trade at 0.7 NAV, pay a 3% dividend, and are buying back 1.3% of their stock per year. So actually, you say, well, we already see so much value and such a great risk reward that you basically don't have to go down the risk curve. Could you elaborate a little bit about the valuation views that you have on the market?
Yeah, I think that's exactly right. So you can now buy million plus ounce producers at meaningful discounts to NAV. The largest of these that we own is Endeavour Mining, which is the largest producer in West Africa. And what's really interesting about Endeavour is, in addition to the dividend yield and a share buyback, getting this mid-single digit return of capital on an annual basis, they're still finding 2 ounces for every ounce they're producing, and their exploration costs have been in the $25 range. Going forward, I think we'll see them between $25 and $50. So you're talking about a $7 billion company that's a top 10 global producer that has a great balance sheet. And in addition to the return of capital and good returns on capital, they're also able to grow in an environment where most of their peers aren't. And so when you add all of those things together, you really get something that stands up not just well against the other gold mining companies, but as your table points out, I think this stands up really well against any other business that you're looking at from a financial perspective in terms of the combination of return of capital, growth, the quality of the balance sheet. And in that case of Endeavour, they also have great alignment where you have a board of directors that owns collectively almost 20% of the shares.
Absolutely. I mean, Endeavour is also one of the biggest positions that we own in our funds. I think we've got here a very, very interesting chart, the cost of exploration reserves, US dollar per ounce. I think that's from the Q3 letter that you published. Very interesting. I also see Agnico, and we saw the merger between Agnico and Kirkland, but also we see Newcrest, who just announced buying Pretium. So first of all, what do you own one of those companies? What do you make out of those acquisitions? And do you think that now this whole M&A activity really will pick up more? We're hearing rumors all the time that Barrick has enormous pressure to make a move, but they haven't moved yet. I talked to Mark Bristow in Colorado Springs, and he felt pretty comfortable. Or it seems to me, at least to me, it seemed that he's in a comfortable position. But the market probably expects Barrick to make a move. So where do you see the whole M&A development going forward?
I think it's still relatively early in the process. So if you look at the Kirkland or Pretium, right, these are the target companies, but they're producing companies. So the seniors are buying other producers. In the case of Kirkland, there was no premium. In the case of Pretium, we had a 23% premium. So a sensible premium, but if you look on a resource ounce basis, and this is in the case of Pretium, assets in BC, it's less than $100 an ounce. So I think it's still early, is that the premiums are relatively low. The PNAVs are low. These are attractive deals for the acquirers, and they're buying not marginal exploration assets, they're buying producing assets. Mm-hmm. Yeah, I think these are, in both cases, good deals for the acquirers. More generally, rather than having to go buy an ounce out there, you'd rather be able to find an ounce for $25 to $50 than have to pay hundreds of dollars per ounce in the M&A market. And so the companies that can do that are, I think, worth significantly more than where they're being valued in the market. And this is very much, I think, a story of in the case of the guys that have the higher exploration spending that's less productive. This is a kind of a case of the dog that didn't bark. Is the guy spending $300-400 to find an ounce of economic gold are not putting that in their presentation. They're not doing the hour-long infomercial about their exploration program. They're just not talking about it. And so I think that's something that just investors are probably not sensitive enough to.
I agree. I agree. Um, you also inserted this one, which is very very interesting. As Endeavor is one of your biggest positions, and I think you're also very excited about the outlook for the company. Could you briefly talk about what excites you so much about Endeavor, and perhaps also, as political risk nowadays is a big factor, why you feel comfortable with the political risk in buying Endeavor Gold?
So I mean, so West Africa for millennia has been a major gold producer, and really I think what happened in the post-colonial period made much of West Africa uninvestable, unattractive, and so you just had some really significant greenstone belts there that were underexplored, especially in French West Africa, that hadn't really, until Mark Bristow proved it up with Randgold, been the subject of really modern exploration techniques. And we're going to see West Africa is going to be the largest gold producing region in the world. It's going to surpass China. And what's really amazing, and almost all of that's happened this century, and the vast majority of that has really happened since 2008. So in the last 12, 13, 14 years. And you're talking about mine after mine after mine being brought on time, on budget, with significant, and this is what this chart's showing here, is this is not greenfields exploration, this is brownfields exploration. This is Endeavor finding ounces next to the ounces they've already found, because these were radically underexplored assets prior to 2008. And so I think the economic opportunity here is huge. West Africa is very much in the business of mining gold, so there's a lot of headline risk. But we're not seeing what we're seeing in say, Latin America, for example, which has maybe at the margin a little less headline risk, but has a lot more friction in terms of bringing projects on time, and much greater incidence of actually stopping projects once they're built or partially constructed than what we've seen in West Africa. So I think it's an opportunity. It's a place where maybe investors aren't that knowledgeable about the local situation and are not committing capital in a way that kind of corresponds to the underlying investment opportunity.
Excellent. Another great chart that you presented is this one. I think many people have come across this one, basically showing that no major gold discoveries were made in the last couple of years. As you know, I'm on the board of Tudor Gold, which came out with the maiden resource of roughly 20 million ounces in February of this year. So this definitely was one of the very, very few large discoveries over the last couple of years, if not decades. Now, Sean, first of all, I wanted to ask you how much you would say that technology that is now really being used more and more in this industry. The more I discuss and research what's going on technology-wise in the mining industry, the more excited I get. Do you think that this could really move the needle, and that we could become more efficient and make discoveries more quickly due to the enormous development of new technologies? And the second thing that I would like to ask is, I'm always a bit hesitant when it comes to peak stories. So obviously, peak gold was a big topic over the last couple of years. From my point of view, I think the market will basically solve this as it always does. So I think at a price of 2,500 or even higher, there's quite enough gold, and we should not forget that the stock to flow ratio of gold is significantly higher than with other, let's say, normal commodities. So it's not only about the new production; it's also about the stock of gold that is obviously also being traded. So from my point of view, this whole scaremongering regarding peak gold doesn't make too much sense. However, as we can see on this chart, there's obviously a lack of investments. Gold exploration budgets were cut down significantly, and it now really seems this is also something that I experienced talking to many people, that it's just hard to find really good geologists. It's hard to find good drillers. So there's really a lack of human resources in this sector. So how much do these longer term drivers from the exploration side and also leading to discoveries, how much does this impact your investment process?
Well, I'd start by saying, the market's not asking you to pay for ounces the companies haven't yet found, right? You can buy now in the seniors, these are, to get these PNAVs, we're depleting reserves, not resources. So, you can pay meaningful discounts for million plus ounce producers to NAV for ounces they already have that are economic. For juniors, so we'll go back to West Africa, whether it's West African Resources, which is a slight premium to half of NAV, or Zone, which is in construction, which is at a meaningful discount to half of NAV, and those are for the ounces that they already have. If they find more ounces, again, that's the market's just not asking you to pay for them. They're not even asking you to pay for the ounces they already have. The second thing I would say is, this is an industry that's kept ASIC flat for 12 years, right? So going back into peak ASIC 2012, we're still below that. So if we're going to keep ASIC at, $1,000 an ounce, and we're going to budget new projects that are going to work at $1,200 to $1,300 gold, we're absolutely going to have peak gold. If we're going to start using, a higher price deck, as you say, price is going to be the solution, and there's a lot more gold to produce, but you're going to need meaningfully higher prices to do it. And I've been surprised at how hesitant the seniors have been in terms of moving their price deck for new investments, and that's why you're seeing that return of capital, is because if you say this has got to be a good investment at $1,200, $1,300 gold, the reality is you're not going to be growing much. That'll eventually move, and investors have to move as well as the C-suite and the boards, right? Investors are still punishing companies for growing and for imputing higher gold prices in their capital budgets, because it's just not currently what the market wants to see, and that's very characteristic of this kind of bear market mentality we're still in.
Absolutely. Sean, to finish off, I think it would also be interesting if you're able to, because our compliance officer is always a bit hesitant when we talk about specific names in our portfolios. But what I would like to ask you from your fund, first of all, what's your exposure in the silver space? Because we are now with our inflation signal that has weakened off over the last couple of years, over the last couple of months. So we reduced our silver exposure. We reduced exposure in small and mid caps, so we're now primarily in the large caps. From the gold space, we're also overweight in the royalty space at the moment, based on our inflation signal. But as I said, we are more top down driven. From your expertise, where do you see opportunities in the silver space, and perhaps also if you could talk about specific names more in the developer space or even in the junior explorer space that you like at the moment?
So with respect to silver, I think that we're going to continue to have that very strong correlation with gold, and I think in percentage terms, silver is going to do better in gold in a bull market for monetary metals. I don't think that's changed. It's varies between 20 and 15% of our portfolio in terms of our overall silver miner exposure. And one of our largest long-term positions there has been MAG, which on a PNAV basis looks expensive, but if you look at their joint venture property and you put any value, any meaningful value on all of those veins that are on Fresnillo's 100% owned property on the idea that they continue onto the joint venture property, because presumably the geology doesn't change just because there's a line in terms of exactly what Fresnillo's percentage ownership of those assets are. I think that's a company that can continue to grow for decades in terms of its production, and it's just not getting the kind of premium value that it should. More broadly, going back to the gold space, I think those three companies I listed in West Africa are a great example of the opportunities in the market. So you can pay your 90% of NAV for an endeavor where you're a top 10 producer, you have very aligned management and a board, and you've got great exploration upside that's not in that NAV. Then you go down to your 50 to 60% of NAV for WAF, which has got a great asset in Sanbrado that they've brought on time, on budget. They've done two really interesting acquisitions from B2 in the last year, in Tuega and Kiaka. CEO chair is very aligned, owns a lot of stock, Richard Hyde. And then you can go down to your 30-40% of NAV, also in the same geography there, with Orezone, where you're paying well less than $100 an ounce in construction. I think they've gotten in terms of a timeline prior to the real cost inflation in CapEx. They've got a great partner in Lycopodium in terms of the construction. And there, I think there's just a huge re-rate as that project comes on time, on budget over the next 14, 15 months. So that's kind of, I think that in a one particular geography just gives investors a really good sense in terms of the range of opportunities available in today's market.
Thank you very much. Now we're already coming to an end, I would say. Perhaps to give our audience a little bit of confidence, I called it the mother of all cup and handle patterns. So from my point of view, if we should go above this massive resistance, which is basically at the all-time highs, then I think it can go to significantly higher levels pretty quickly. And one confirmation, I think, I did an interview on Kitco. By the way, your interview on Kitco was also very, very good. I really enjoyed that. But I was asked by Kitco about my experience at the Precious Metal Summit in Beaver Creek, and I said, well, I talked to a guy who's a long-term friend of mine, and I would say, in a respectful way, he's a die-hard gold bug. And he asked me, where do you see gold going forward? And I said, well, I can easily see it making new all-time highs in the next couple of months. We're only $200 away. And he said, no way. It's absolutely impossible. Gold is dead. And what I wanted to say, I think if really people that know gold so well are that pessimistic, $200 below the all-time highs, I think that's a very, very good sign that there's basically no confidence, no optimism priced in. So I think as soon as we go above this resistance zone, then I think it can go pretty quickly, because now at the moment it seems gold is, for most people, most investors, most journalists, it seems it's the most boring thing ever. But I think it will definitely come back in fashion, especially due to the whole macro picture that we all see developing. Now, Sean, thank you very much. I really enjoyed this. I hope you, dear viewers, also enjoyed this. I hope that you're having a tremendous virtual Precious Metal Summit in Zurich, but I really hope that we'll see each other in person in Zurich, in Beaver Creek, wherever, very, very soon, that we'll be able to shake hands, to have a good conversation over coffee or a beer, and I truly look forward to that. Sean, thank you very much again. I really enjoyed that. All the best. Keep up doing such a great job, and see you very soon. Thank you very much.
Thanks, Ronnie. I enjoyed it.
Thank you. Bye-bye.